1st, good afternoon, April 1st, 2025.
Garth,
April 1st.
Garth, I
good
have to
Lord.
take exception right off the bat.
Oh, Lordy.
So on the West Coast,
Yeah.
where California contributes X amount of origination, it's still the morning. So when you say good afternoon,
Yeah.
I think that is an East Coast centric way to start this call.
Okay. Hello, April 1st, 2025.
Happy Tuesday.
Happy Tuesday. And there you go. So we appreciate everyone being here on April 1st. I will have to say, we originally were going to talk about and share some of our insights around the data that we have collected about the digital mortgage environment. So very tech-centric presentation, which is why Rob Chrisman wasn't going to be on. Because
wow,
exactly. Well, he already missed it.
Like
Sue, he already called me out for East Coast bias. So
you know what? I missed 30 seconds and I missed
there's nothing wrong with my flip phone, Garth. It still works just fine.
Yeah, nor your visits to the bank to deposit checks.
I went to the bank today, as a matter of fact, and offline I'll tell you why I went to the bank and deposited some cash.
Okay, got it. All right. So I guess the big thing, we were going to talk about technology and digital technology, but we kind of figured yesterday a little something happened in the industry that may be worthy of us discussing instead. And in fact, I woke up on 3/31 yesterday. And I woke up in the morning, by the way, Rob, if you want to call me out on that. And I saw a text from someone saying, Rocket has purchased Mr. Cooper. And I immediately thought, ha ha, it's April Fool's Day. Because I knew it was April Fool's week, but groggy pre-coffee on 3/31, I kind of, just like got completely thrown off. So I actually had this flash that thought, hey, it's April Fool's Day. My second thought was, oh my God, I'm so excited to read Rob Chrisman's April Fool's Day commentary, which is always a highlight. And then enjoying the parlor game of who actually takes it seriously and has a fit about it. But it wasn't a joke. And it's not a joking matter. And we think it's obviously something that's prudent for discussion. So Rob, thank you so much for joining me at the last minute. And then Sue as well. So if you want to say hi, Sue.
Well, hello. Sorry that I missed the opening moments here, but I do have to tell you before we get started, being in Siesta Key at the moment, the Siesta Key Observer does something kind of interesting that we didn't notice. So earlier this week, they put out a newspaper a couple of days ago, and it had all kinds of interesting things in it. Oh, you're not gonna be able to see it with this, but they had some things in there that they have a big victory in Japan statue of the Navy sailor kissing the nurse in Sarasota, right by the bay. And they had this big article in the newspaper about they were going to replace it with a statue of Donald Trump. And then they had another article about how they're going to encircle St. Armand's Circle in a giant dome. They had a whole thing about they were going to start drag racing on Fruitville Road. And we were getting ready to go tonight. I was like, drag racing, that's going to be amazing. And then today they came out with papers saying all of those stories were April Fools. So no statue of Donald Trump, no drag racing.
First of all, Sue,
yes,
when you said the Siesta Key Observer, I thought that was your nickname for some stalker out your window every morning.
Yes, exactly.
Watching you in your pool cabana.
Yes. Well,
there's the Siesta Key Observer.
Stranger things have happened. We've got definitely a Florida man down here. So, but yes, many stories are catching us all off guard. But I'm glad we changed topics this week. And I know you two certainly probably have you have a lot of insights and opinions. I actually went online this morning and gathered a few questions online as well. And so I'll be sprinkling those in, and I'll certainly be watching the chat. So for folks
hold on.
Yes.
When you go online, don't you go online to find answers and not questions?
I actually was going for questions this time because I feel like I have a lot more questions, and I'm looking to you two to have a lot of answers. And so I thought, I bet other people have questions as well. So I wanted to gather a few, which I did. So
absolutely. And by the way, there's no truth to the rumor on April 1st that Rocket is now buying Home and Garden TV. I think that would have been the classic. And the reason is because then it could be Aaron Napier and Ben, like just doing all these amazing houses sponsored by Rocket. I'm probably giving them an idea as we speak. They could bring
There you
back
go.
Tyler Pennington, the dude who used to do this for G-Rate.
Yes.
It was on
Yes.
Home and Garden. They can have those two brothers that sit there and fight over whether they should
Yes.
remodel or rip. Yeah. I mean, it would all be like Rocket from Home and
Wow.
Garden TV. Yeah, what the hell? Maybe that's next. But they certainly are getting highly accretive. But I thought that would be another, April.
Well, I feel like we got to dive into it. I would
Yeah.
encourage folks listening live to use the chat. If you do have questions, I'll be really watching the chat as we go throughout. Because again, I feel like there's probably a lot more questions out there, maybe some opinions than there are answers. But a lot of folks in this industry always turn to you too for guidance, advice, and just maybe even good questions to ask ourselves as we proceed. So I noticed Steve McGurl had a comment in the chat that maybe the new name could be Mr. Rocket. But
Too, as the years have gone on, I've done my best to dissuade people from looking to me as a font of information, and it's gradually working. The baton is being passed to Robbie, but I'll do my best.
All right. Well, you're both quite a font of information, if you will. But I think I will ask. I'm going to get started because the headline question that I heard from a couple of folks online and that I have myself is Michael Browse asked this question online. He said, first of all, I'm just surprised that the powers that be, whoever those powers are, would allow a seemingly quasi monopoly to be created with Mr. Cooper, Rocket, Redfin. 1 in 6 customers or more are going to be directly marketed to by this behemoth. This should be interesting, question mark. So what are your thoughts just on that? I've heard a handful of people ask that question.
So we're already getting into the election results from last November.
Exactly.
Let's go there.
So go ahead. You can take this one first if you like, Rob.
Well, so we probably have, over 100 years of collective mortgage experience between the three of us. And you guys have been, and Lord knows how many, start adding up folks who are watching right now. But when you look at the business cycle, when you look at the cycles that mortgage originators have been through, there's never been a time, it's almost as if the old saying about no tree grows to the moon. Well, no mortgage company ever gets more than X market share. And I remember the days when Countrywide, Angelo Mozilla, or whoever was shooting for some market share percentage.
Yeah.
And I always thought that's the wrong thing to do. If you get to a certain market share percentage because of your policies and procedures and pricing and service and so on and reputation, that's one thing. But to actually try to hit a percentage, that just leads to trouble. When you look at who the top originators were market share wise 10 years ago, it's different than it was 20 years ago. It's different than it was 30 years ago. And frankly, I think it's going to be different than 10 years from now in the future. And so I think that, first of all, we have a political climate that is not known for its, now what's the politically correct way to say this? Its eye is not on it's very pro business, pro free market. If somebody wants to make a monopoly, let them, kind of thing. I don't know how to put it exactly, but I would say the Biden administration and traditional Democratic administrations have looked at business one way. Donald Trump looks at business another way. We saw that in Trump 1. Now we're in Trump 2. And so what better time to announce some of these mega deals where regulators might not be so picky, as it were. So yeah, politically, it's a good time. I think that Rocket has watched United Wholesale grow, and this is the last thing I'll say, and then Garth, you can take over. But we're dealing in an environment where, whether it's Stan Middleman or Matt Ishbia or Dan Gilbert or you name it, it's a very competitive business environment. These leaders and owners of companies are generally not doing this for their health. They are very competitive, and it's not enough for somebody to succeed, others must fail. And so we're in this environment where all these things are coming together. So yeah, I keep telling people, we're not done with 2025, and I would expect to see more deals like this. Garth, what are you seeing or thinking?
Yeah, I think absolutely. One of the things in mortgage banking, so is it anti-competitive, which I think was the question that I got. So very quickly, the industry is still on the origination side. Let's talk about that first and then servicing. It's highly fragmented. It's still, and this doesn't dramatically change it. This makes Rocket from an origination perspective, direct origination, about a 100 billion and a 1.7 trillion dollar market. So 5 to 6% market share. I mean, does that swing? Is that Coke and Pepsi? I don't really think so. Now, that doesn't include the fact that Mr. Cooper is a machine on the loan acquisition side, but that's not really changing in anti-competitive perspective, changing the consumer. It's not impacting consumer that you're the one that acquired the servicing maybe after the fact. So I'm not sure on the origination side it dramatically changes it at the moment that an antitrust regulator would have to approve it. On the servicing side, it's also like, what's the impact if you have a ton of servicing versus less than a ton of servicing? I mean, is it anti-competitive? Will somebody jump in? I don't really think so. But we are still a highly fragmented market. The good news of that is if you're in a highly fragmented market and trying to compete, it means there's a lot of room to compete in. It doesn't mean that I think you shouldn't take it seriously and figure out how you compete. And I think we should spend some time talking about it. But I don't see it dramatically changing the competitive balance this year, which is the time at which a regulator will have to ultimately weigh in and approve it or not. And then I don't know if you've noticed, and I bring this up, because we're talking about great periodicals like the Sarasota Observer. I was quoted in the Wall Street Journal yesterday. That's a drop, isn't it? And my quote yesterday was that there's already been some consolidation. $2 billion originators, the number of them has dropped by a quarter in the last 2 years. So if you said how many lenders do over 2 billion, which is kind of a litmus test of being, big enough to compete, it's a quarter less than it was just 2 years ago. So we're already seeing some consolidation. I think this will also see consolidation, and very much I wrote an article about it when I saw the NAR settlement. I said, will this finally change the number of realtors that are participating in the market, which will thereby affect the number of loan officers who participate in the market? Because it's still an industry that's kind of 1 million realtors being served by 100,000 loan officers. If that calculus changes, then I think it could dramatically impact on the lending side as well. Because, a lead behemoth like Rocket is pumping leads into a Redfin that maybe suddenly becomes bigger and the model changes. So
a quick note on that before we shift over and start talking about how our loan officers, that's some of the audience here is how are they impacted? What does this mean to me? And then generally just competitive in general, what does this mean? How do you compete? There was an audience question that popped up, and again, encourage people to use the Q&A or the chat if you're able to. The question that came up related to what we were just talking about is, does this acquisition make Rocket too big to fail? And our friend Hans Haseman made the comment, well, with a market cap of 25 billion, Rocket companies are still only a quarter the size of ICE. So who is too big to fail? So Rob, any headline thoughts on that?
Yeah, I don't think it's too big to fail. And we tend to, when we tend to say Rocket this and Rocket that, it's actually Rocket companies. And there are several, for example, I chatted with Dan Gilbert at one point, and he was just getting ready to roll out his sneaker business, which is probably also under the umbrella of the Rocket companies. So there's Rocket Mortgage, which is part of Rocket companies. I don't think it's too big to fail. As Garth pointed out, the industry continues to be very fragmented and distributed, and yeah, it's certainly caused some heads to turn, but there's hundreds, if not thousands, of branches that or loan officers that move around every year or every month that tend to migrate as well. They don't get the headlines. Obviously, a big deal like Guild buying Academy or Cherry Creek or something, or a Rocket and Redfin Rocket and Mr. Cooper. Those are headline grabbing numbers, but it's still, if you look at the, I think last week I published the top 50 lenders, originators for 2024. I mean, it's a very diverse group, and there's still a lot of business. If we do 2 trillion, that's still a lot of business to go around. So no, I don't think it's too big to fail. I don't think Rocket has become a systemically, I don't think it's the foundation of the economy like a Chase Bank would be, for example.
Yeah, and it's Fannie, Freddie, and Ginnie servicing, for which there's a implied backstop or explicit backstop, depending how you look at it. But it is absolutely not really a like somebody taking a lot of loans on the portfolio. Nor do we expect, the industry is not forecasted to have dramatic default rates that would create these cash flow crunches which occurred during the meltdown.
So let's
I'd
shift
say
gears
no.
and talk, a little bit about just the kind of obvious competitive issue when we've got an entity with 1 out of 6 mortgages under their domain. Garth, we'll start with you. I mean, how do you see lenders really competing against this?
Yeah, so in many of these advisory angles where we talk about from an advisory perspective, how people should look at this, I often fall back on the same thing, and that is ultimately all great change is a people, process, and technology element. It's not one, it's all 3. And if you really want to drive change or change your business, you really got to look at all 3. So I would sort of say it's people, process, and tech, and take them one at a time. From a people perspective, you need to likely look carefully at how much business are you getting from Redfin agents. So if you are a branch, you ought to know it for your LOs. If you're a company, you ought to know it for your branches. You really need to understand how much you're getting from that. Because if you're getting that, the Redfin's capture rate within their business was roughly, let's say, 25%. So they were getting 25% of the Redfin business at its height. In the best offices meant 75% was going somewhere else. Where's it going, and am I getting? And if I started losing that, would that impact me? And if so, go get non-Redfin agents. Go find Remax or whatever. Now I was a loan officer once, so I'm saying, hey, go make sales calls. That's kind of what I'm saying. But be very, very smart about it, because trying to bang the hell out of Redfin to get Redfin business may not be the right route to go. So that's an element of people, because it's really your realtors and your LO relationships will still drive some volume in the short term, but you may want to be a little more strategic about how you're doing that. The other thing, and I keep saying this because of the risk that the realtor market, based on the NAR settlement and based on this, could start to shrink. At least the volume start to shrink. Are you getting enough business from high producers? And if not, how do you develop relationships with them? Once again, if you're LO, hand-to-hand combat. If you're a branch, what are your LOs doing? If you're a company, what are my branches doing? Who are my relationships really with? So I think you need to look at all of those elements of people with an eye towards the fact, what is Rocket getting on the lending side? And you should be looking at the data that tell you that from your customers and clients and realtors. And what is Redfin getting? Because that is now a combined competitor. That's the people part. And I'll talk about process and tech later. So what do you think, Rob?
Rob, anything to share on that?
Nope.
Nothing. Okay, you got nothing. I mean, and I think, Garth, kind of to your point, anything deeper that you'd share, in terms of, again, a loan officer that's listening to this, should they be concerned, or what immediate actions are you saying that they should take, given this news in the market? How should they be talking to their customers and real estate agents about it?
Well, all right. So once again, caveat, I was a loan officer once. So as I'm about to say something that's going to make somebody want to shoot me, luckily this is video, so you can't hit me either. At some point, a model where you're getting paid 100 basis points on an average loan amount of $400,000 may not be sustainable. And granted, nobody wants to be the first, but if they are successful, Rocket, driving business into more of a call center centric model, it will be at a lower sales cost. It may have a high marketing cost. It may have lower pull through, but the sales cost at 100 basis points, you really should look at, Are you better over time if you're a loan officer, if you're a branch, if you're a company, looking at doing more volume and having more relationships at perhaps a lower compensation in order to be more competitive in a market that may be changing? And granted, I was a salesperson once too, so I say that with all the apology and all the empathy that that implies. But at some point, the average loan amount keeps going up and we just keep paying the same basis points. It keeps driving our expense up. And at some point, you're going to have to ratchet that in if indeed somebody is successful driving it into a lower cost channel.
I think it's a fair conversation to have, and you've got
Yes.
some very good articles on that at stratmorgroup.com. And so when we repost the replay of this, we'll put one of those links in there that links to some of your talks about compensation, because it's a hard truth and it's a reality. So
Yep.
Courageous to bring it up here while we're on video and nobody can smack you over the head. But
Right.
let's shift gears to your point. You talked about people, process, technology. Talk a little bit about the process elements of this. I mean, let's start with you and then transition over to Rob.
Well, I think the big one is if you listen, well, what we know about their data, and we've listened to their investor calls yesterday, they're talking about the ecosystem, and it's very robust, and it's tens of millions of shoppers every single month. What this means is they are trying to build an ecosystem that the consumer has information online to drive the process. Search. They have the ability to interact on getting mortgage qualification. They have the ability to interact with realtors, maybe under a different model, to talk about what their options are. There may be a model in the future where the realtor and the consumer and the loan officer are supported by a single person or a concierge that manages all of this. I'm describing a process that is very different than the way we do it now, which is lead generation, handoff, personal referrals, loan officer origination, handoff to processing, handoff to underwriting, handoff to secondary, which ends up in servicing. That's a lot of handoffs. And what they're really saying is, what about an ecosystem where all of that is built in? A single ecosystem where you can start with just search, home search, or just searching about mortgage and having an AI bot engage with me and start talking to me about the real estate process writ large, or the opportunity to buy. That is a fundamentally different process. If you're a loan officer, branch, or company, how do you inject yourself into that process and add value? Or how do you compete at a process where maybe there's less handoffs and it's significantly more efficient? That won't be, by the way, day one. And we don't have to freak out. This deal's not even going to probably close for 6 months. But you ought to be thinking, how do I make my process significantly better?
Rob, what would you say to that?
Nothing more.
Nothing more to add. Well, one of the questions
I mean, Garth has covered the ground here. I will argue, or I will suggest that I always root for the underdog, and the fact that it would be an interesting study to do to see let's take Major League Baseball. Each year, they calculate the salaries of the players. It would be interesting to see how many years does somebody win the World Series who had the highest payroll. I would argue that most of the time, the World Series is not won by the team with the highest payroll. When you look at the diversity that exists in this industry, even though you could have a lot of bells and whistles, there's still a huge number of people who may not necessarily take advantage of those bells and whistles. They still want to go to the bank branch. They still want to go to the credit union because they're a member there and they have popcorn on Friday afternoons and once a quarter have the clown show for the kids. That will determine their business, where their business goes. And yeah, you have a juggernaut, a huge thing, and loan officers might be spooked. But Garth, you made the comment earlier about real estate agents, and I always make the point when I'm speaking to audiences, especially when they're loan officers, I remind them you know what? Not all loan officers are built the same way. Are you calling on the or are you calling on the real estate agents who are actually doing the business? Or are you just
Yeah,
taking,
of course.
cookies to the real estate office, and maybe they did two deals last month? So you have to be smart, and you can be big and have your competitors be smarter. You can have all the bells and whistles, but when you're dealing with human psychology and people's preferences and their likes and dislikes, uh, it's a different issue. You have a segment of the population out there that may not want to deal with a rocket, or rocket makes a misstep, and their reputation is threatened. And so, look at Wells Fargo uh, from years ago. They
Yeah.
misstep after misstep after misstep. If you look at Wells Fargo's rankings in residential lending 10, 15 years ago, they were number one. They were huge. Where are they now? They're in the rank of 50. I don't even know where they are. They've done away with wholesale. They've done away with correspondent. They focus on retail, and they're not doing much at all. So there is reputational risk out there that can impact a Rocket or a United Wholesale or a whoever, Freedom, or what you name it. And so I think that Garth has touched on some fantastic things to think about, and from a global perspective should be looked at and thought about. But if I'm a loan officer out there and I'm dealing with this news flow of, oh my gosh, Redfin, and now they've got the realtor side of things, they've got the loan side of things, they've got the servicing side of things. I may as well just retire to Siesta Key and call it a day, and sit in my cabana. Well, no, because the good originators out there, no matter who they work for, are going to go back to work today, back to work tomorrow, the next day, doing what they can do to help the clients that they have, and go out and get the business that they can, and do it smartly. And those are the people I think who will continue to succeed.
So I'm going to throw in a contrarian point of view, Garth, to what you shared.
Awesome.
Not from me, but from MarketWatch. So MarketWatch had an article that came out yesterday where they made the comment. They said, everybody wants to be the Amazon of real estate, but if there's too much concentration in the industry, it raises the question of whether the buyer is getting a fair deal. They're making the case for saying, with such a large entity, could they actually have prices, the cost of doing a loan go higher. And one of the experts they quote here in the article actually says the convenience promised by this merger could also lead to an increase in home prices. He's saying that as buyers are potentially paying agents less and less, that it could actually cause the home prices to go up to make up for the fees not being paid out to agents. Now, again, a little controversy, a little different than what you brought up. But I mean, Garth, how would you respond to that?
There's 1 million realtors and they all belong to the same, mostly, a vast majority of them belong to the same union. That's my response. We already have a level of, and the lawsuit addressed it, so I don't want to get in too much detail, jumping in on this topic, but prices are high due to macroeconomic factors associated with the overall cost of real estate, for which is the competitors in the space are not driving that. Not enough inventory, things are too expensive, that type of thing.
Mm-hmm.
And the second is, though, it's the consistent 6% has an impact too. But whether, whether it's the lawsuit or a Redfin, which is traditionally a discount brokerage model, and a Rocket combining changes the economics, that could happen. But I can't see how it makes it higher priced. I don't see it. So you asked the question. I see higher prices coming. I just don't see it related to Rocket and Redfin combining.
I agree. I mean,
Cooper.
I don't think the cost of soda pop has gone up because Coke and Pepsi dominate the market, for example. I mean, we all know, you guys know Jeff Babcock who I see on a regular basis, and we have lunch with the guys from Bay Equity, the owners of Bay Equity, who sold to Redfin, and now Redfin is sold to Rocket. And in talking to those guys, Garth, as you pointed out earlier, they view their success as the ability to reach how much of Redfin's business goes to Bay Equity, for example. And frankly, it's not as much as you might think, despite being sister companies and despite giving, price, I mean, just there are benefits to using your sister company. There are benefits for Redfin to use Bay Equity. And yet Redfin agents oftentimes would drive business in large percentages elsewhere. And so I keep coming back to personal preferences, and we're in a people business and so forth. And when you talk about, driving the price higher, I agree 100% with Garth. I mean, it's the fact that there's 70 million millennials running around out there, many of whom want to buy a house and they don't own a home yet. And the baby
So it's
boom
Robbie's fault.
Huh?
It's Robbie's fault.
Yeah.
Your son.
I blame everything I can on Robbie every chance
It's
I
Robbie.
get.
It's
Don't
your
blame
fault.
me.
All right.
No, both my kids own homes. Thank goodness, they've done a very good job of that. But they want to own a home. There's a lot of people who don't want to own a home, but Garth, to your point, the demographics point to higher prices, the lack of inventory, lack of builders keeping up with demographics have led to where we are now. The cost keeps going up. You look at homeowners insurance, you look at condo HOAs. I mean, these are problems that are driving prices higher. It's not the fact that Rocket is buying Mr. Cooper.
All right. Well, I'm going to post that link to the Market Watch article when we post the replay. So I want everybody to at least check it out because it's an interesting point of view. I want to shift gears and go to data in a moment because I think that's a pretty interesting part of this. We have a few questions from the audience. I want to make sure we covered off on Ariel's question because Rob, you touched on this a little bit, reputational, but Ariel said, what does Rocket not have? And do they have any reputational risks? And I think, Rob, you brought this up earlier, the CFPB under Trump did drop the charges against Rocket that were brought up under the Biden administration in terms of, maybe a reputational challenge. But, anything else either of you would add on just any reputational risks to answer Ariel's question?
Well, I will comment on this one. I wouldn't say this is a reputational risk piece, but culturally, Rocket, the vast majority of the loans they have in servicing were loans originated by Rocket or through their TPO, which is tightly connected to Rocket TPO, meaning it was a quick hop from the broker to Rocket. So their customers are more their customers than Mr. Cooper, which the vast majority all came by purchasing a closed loan completely originated elsewhere, a servicing. I mean, by the way, if you think about this, Rocket now owns Flagstar. I mean, apologies to the bank, not the whole bank, but the mortgage group of Flagstar, which went to Mr. Cooper, which has now gone to Rocket, tagged along with Redfin and Mr. Cooper. There's a lot in there, but the vast majority of the Mr. Cooper piece are people who originated their loans completely somewhere else. And granted, they've been branded and had an experience with Mr. Cooper and they have digital tools, but it's not the same as what Rocket. So culturally, Rocket and Mr. Cooper, they're going to have to put this together. And one of the things they said in their investment thesis, it was, we're going to have this significantly higher recapture rate. And Rocket has some amazing tools around their ability to recapture refinance opportunities out of their servicing port. But they're really going to have to sharpen their blade because it's going to be a different experience getting it from loans acquired through bulk and co-issue and servicing transfers and everything that really make up the portfolio of Mr. Cooper.
I heard from a odd source today, and that's a public notary who travels around in the middle part of the U.S. and notarizes documents. And this notary said that they are tickled pink every time a Rocket deal crosses their desk because Rocket has a reputation out there with, the notary brethren of making clean, tidy, concise, well-documented, well-organized files. And so that was an interesting perspective because that's a good reputation to have. So,
Oh, hey, by the way,
It is.
that's exactly some of the points I was talking about related to process. Because the better your process is overall, all those handoffs, that's a handoff. That is literally the last handoff in the process that they have done a pretty good job with. That's what you're sort of saying. And those little handoffs add up to a lot related to experience. And I'm just going to do this one thing, Sue, because you and I are involved in some of the work we do related to secret shopper. When we secret shop the customer experience through clients, it is staggering what we find. And it's a lot of little foot faults, but it adds up. And it's things like a point of sale system and an LOS not being tightly integrated. The CRM sending reminders to people to complete a loan application you already submitted 15 minutes ago. Getting something saying, I need a big bank statement when you already put it through the point of sale 1 hour ago. And I've just described things that technologists would say, yeah, but it's not real time. And oh yeah, there's some issues. And these are all small. But that happens on 55% of loans based on our data. Some sort of hiccup like that dramatically impacts the process. And it's lots of little paper cuts. And the other one, and I'll say it for salespeople, when we shop, do our secret shopper, 80% of the time, the conversation we have when we're acting like a consumer and describing why we're buying a home and saying these things of what it means to us in our secret shopper scenario, 80% of the time, that does not end up as notes in the CRM. It doesn't end up, it's gone. Which means if somebody talks with me 2 weeks later, they might remember, in which case they must have a memory of an elephant, because how many customers have you talked to in the last 2 weeks? But you end up calling me back and asking the same damn questions over and over again. Those are all little process hiccups that anybody in the business, loan officer, branch, or company owner could really look at and say, I need to be the best I can be on my people and all those process handoffs and tech in order to compete with where these elements might go. I don't think they're an existential threat, but you better be on your game, because there could build some very slick technology that involve all the players and all those processes, including the notary who thinks the process is good. So there you go.
That's right. That's right.
Garth
And I think
Garth's fired up here. It
I
reminded me
am.
he's got
reminded me of the
sleeves rolled
scene
up.
from Animal House. Like, remember when the Germans bombed Pearl Harbor?
On Pearl Harbor, except, yeah.
They run out of the jeans off. Anyway, go ahead,
whole
Sue.
thing. But I was gonna say it's a good point. And remember, Rocket got everybody fired up, at the Super Bowl. I remember push button, get mortgage, and everybody was, oh, what? But it caused the mortgage industry to level up, right? And say,
exactly,
we have to be a little bit better. We have to have, we've got to get digital. We got to upgrade our systems. We need to pay much more attention to our tech stack, pay more attention to that customer experience. And I think you're hitting the nail on the head there, Garth, is that this is another level up moment. Is everybody better be looking really hard at their technology, their process, and their people, as you've said, Garth, to really be paying attention to how they're going to compete.
The fact that you mentioned Market Watch earlier, Sue, that makes me want to start reading what my competitors are out there writing. Normally I don't.
Somebody sent it to me because I don't read anything but Chrisman Commentary.
Okay. All right.
That's it.
All right. Good to hear.
Okay. So I've got a question.
Garth quoted in the Wall Street Journal, so we got to read that.
I know, it's kind of a big deal. I know.
Exactly.
Well, we'll put the Wall Street Journal link out when we repost the replay here as well. But we've got a question from Michael Pavlicka, who says, with a gazillion terabytes of data, AI bot interaction, and call center LO, is this a better option than boots on the ground overall? So it's a fair question, right? There's a lot of data, and I want to talk just for a couple minutes about data, but just get your initial feedback on that question.
Right now, a high percentage of the time that we take a loan application, we say, I'm going to send you a link, fill it out. That is an impersonal experience. We secret shop it. It's literally what the LOs say over and over and over again. High producers to low. Go ahead and fill it out. The reason, because we have this great digital app and I don't have to waste 30 to 45 minutes. Imagine a world where you're having a conversation and you're just talking to the customer about what their goals are, their ambitions, while asking them, by the way, where do you work? Oh, terrific. How long have you worked there? Oh, that's awesome. Is that like a normal pay? Like, do you get paid every 2 weeks or do you get bonuses? How's that work? Oh, awesome. What's your starting salary? Terrific. You've been there that long. Tell me a little bit more about your house. I'm literally taking an app. It's being recorded. It's being transcribed. The application is being completed. You don't have to send them a link to fill out a point of sale application. The point of sale application is now a voice enabled experience. If you think I'm talking Star Wars, Rocket does that now. They're and they talk about it. They are real-time transcribing and capturing data when they talk to consumers. So that is real data. The technology really exists and it's really coming. So will it replace a human? Well, I didn't replace the human. I just had the human have a much better conversation, a much better experience, and then not create yet this other handoff where they have to repeat the same thing again. So I think a human tech enabled is the absolute winner. And the reason is because buying a home is emotional, it's stressful, it's important. So to the extent you can connect with people, you're going to be a winner. But why do you need to necessarily, do all these other tasks that a system could do if it was supporting you?
That's right. The tech-enabled loan officer, I think, is key.
Tech-enabled
So,
loan
I mean, I
officer.
think a lesson I would take from that is that if you're a loan officer in a company and you're resisting some of the technology that your company is bringing to bear, it is a time that, the industry is changing, the world is changing, and this is a sea change where, you want to lean into those things. And, I was a loan officer and I was first one, I don't want to like learn a new technology. I don't want to log in. I don't know where my password is. I get it. But, this is something that when you think about how does it come down to your level as a loan officer, probably need to lean into some of the things. And if you're not sure what all the things are that your company has available, ask the question. Because I'm actually floored when Garth, we work with lenders and take a look at their tech stack. We're like, wow, how many people are using these amazing things that you're bringing? And very often adoption and engagement are a big topic of kind of contention because people aren't engaging with them. And again, Garth has heard me say many times, there's an onus that's on the technology provider to, have a level of simplicity and best practices and things that are built in to make it easier for somebody who's 100% commission based. You eat what you kill. But right now, this is a time to really regroup, look at what's in you as a loan officer. What is your tech stack and what do you need to lean into to improve your business? So
sometimes when you lean in and you can't get the ball across the goal line, you have to circle back with the team and huddle up to get that flag up the flagpole.
That's
Good
right.
Lord, that was all sorts of football metaphors. Unless you're in the Eagles and then someone pushes your ass and sends you over the top until the NFL outlaws it.
Yeah, what happened to? I
Yeah,
didn't think you could
the
help
tush
your
push.
offensive guy get across the line.
Anyway,
Anyway.
they needed something to enable the Eagles to finally win. They have now offended my friends in Philadelphia. So there you go.
Well, yeah, and I live with an Eagles fan, so it's a whole thing over here. I kept the volume down so we couldn't hear that. But we have a couple
Exactly.
questions from the audience, and then I do want to shift to talk a little bit more about technology because I think
How
obviously
long
there's
do
a
we
lot
go, by the way?
Yeah, good Lord.
usually
This is our longest
45.
ever.
I
No,
know,
we
let's go a
usually-
couple extra minutes. People are hanging
Go
in,
ahead.
so just
No,
hang in there. So
Yeah.
and Chris Van Beaver, who is
Why
also
do
At
you
some
need-
point,
fellow
at some
Eagles
point,
fan.
we will want to sum things up.
Yes, we
Okay.
will. I'm on it. I'm moderating. But thank you. Thanks for your guidance, Mr. Chrisman.
And get
Hans
the ball
asks the
across the line.
question. Yeah, oh, okay. I'm gonna try to take it home, make a goal here. Hans Haseman says if realtors are still your top referral partner, this acquisition has to better bolster your position with agent partners. Up till now, you're fighting Rocket Money leads that are being spoon-fed to thousands of agents. Redfin should gatekeep those leads now, giving the retail loan officer more of a reason to call on agents and work together to fight the Rocket. Oh my. I'd be most curious to hear how this is being received in the halls of the Ishbia family office. Anybody want to touch that one or?
No, but you didn't even put in Hans's joke, which is the best. The Cavs are in the top of the East, and the Suns are now missing the playoffs. That's the best part of his question.
All right,
Comment
well,
right
sorry,
there.
Hansi.
You may as
Sorry,
well poke.
Hansi.
If you're going to poke the bear, you may as well just poke him.
Just go all the way.
I
Sure.
I certainly think UWM is a very competitive culture and has a very competitive owner, and they're likely to have some level of response. I don't know what they'll do, but they'll do something, and it may be they just double down on brokers and do nothing like it, like an acquisition. but they'll have a competitive response. Sure. It's hard to imagine.
Yeah. I mean, at this point, Matt and UWM have been dunked over a couple times. Matt, like I said earlier, he's a competitive guy. All these guys and gals are very competitive. And so, yeah, maybe there'll be a response, or maybe isn't he rumored to be buying a baseball team or something?
Yeah, apparently, Minnesota Twins, who would want to own them? I mean, plus, who would even want to live
Hey,
in Minnesota? Oh, sorry.
Jiminy,
I'm sorry.
Christmas. You
Oh,
know, I'll
Lord.
tell you
This
what.
Aren't
I
you a
just,
Marlins fan now, Sue, being in Florida?
you know, I'm a
Oh,
fair weather
God.
fan of all sports. So speaking
That would
of,
be the
Chris
Rays.
Willoughby let us know that NFL owners voted that the tush push stays. So whatever
All right.
works, man. So couple things before we wrap it up, because we do want to talk a little bit about technology. And there's a question coming in from an anonymous attendee saying, how can LOs compete with Rocket and Redfin's technology ecosystem? So let's kind of answer that question and talk a little bit about technology. We've touched on it a little bit, Garth, as I, got on my soapbox about embracing the technology that lenders are investing in. If you're listening as a loan officer, and if you're a lender and you haven't gone out to your loan officers in a while with some of the tech that you'd like adopted, this is a good catalyst and a good talking point to roll out there with. But Garth, what would you say?
So I'll do a very quick answer. Every single tech question, usually my reply is like, what's the best LOS, point of sale, et cetera, et cetera. What is the best option for me? It depends. It depends on your model, your value proposition, your price point, what's important to your ability to support it, et cetera. So if you are a company asking those questions, we have an entire practice that helps. So reach out to Sue and she'll talk with you about it. I would say, though, if you are not adopting technology, that's on you. You can't just expect technology to be used by people unless you're willing to embrace and use it yourself. Meaning we see, even going all the way back to day one certainty, we see the same day one certainty solutions offered by two different companies with dramatically different adoption. That doesn't make any sense, except that the people in process is failing, or the people in process is succeeding, if you want to look at it on the positive side. So you certainly, whatever the technologies are, you have to have them tightly integrated. You have to embrace using them and have to avoid process footfalls that undermines their value. Those are the pieces I say. I will say, coming out of ICE, though, I also saw a category called agentic AI, yet another category, and that is agent-centric AI, meaning that replacing the behavior of a human, talking, asking questions, getting answers, asking questions, transposing. So if you're not yet seen some of those, reach out to Sue and we can kind of give you a quick primer on it. But they weren't even really around a year or two ago when we went to these conferences, and now there's 4 or 5 that are suddenly being offered. And most of them are new, and it's not something an LO, your question was an LO, it's not something an LO necessarily can subscribe to, but a company needs to be looking at those solutions as well.
You bet. Rob, anything you want to add on technology?
Other than to remind people that people do certain things with technology. And if you're a great baseball player, you're going to be a great baseball player with or without technology. If you're a great loan officer, what makes you great? And do you have the ability to pick and choose the technology that is best going to help you help your clients? So, yeah, I mean, there's a lot of great offerings out there. It's a matter of trying to figure out what's going to help you the best and use it. And don't just add technology, or don't encourage your vendor manager, your IT group to add technology just for the sake of technology. Figure out how to use it and figure out how to use it smartly.
You bet. So just a quick last question, kind of a provocative one, but Ed Vogt is asking, hey, Garth, if you're correct, I like to end with a little spice, but Ed's asking if Garth is correct. And Rob, you mentioned this with your notary friend, but why do agents, builders, and title companies seem to hate working with buyers using Rocket? And Bill made the comment, agree. We love to hear when one of our prospects are talking to Rocket because we win then. What do you make of that, Garth?
Why do agents, builders, and title companies hate to work with buyers using Rocket? all three of those people want control of the transaction. I mean, builders want it to go through their own mortgage company. Title entities want to control that because that's kind of, where their value and their cost basis is. Agents like the local person that they might know. So I think that is a, classic way in which it, people resist Rocket, which is the newer in the change. But at $100 billion last year, they did some. And, I think the more they buy and if they tightly, and this is a big if, tightly integrate these solutions and the experience and the process, I think more might use it in the future. So, but I'm sure there's people who, some agents, some builders, and some title companies for sure will resist, that new way of doing things. And, it could be also be careful of the selection bias. Everybody I talk to doesn't like Rocket. Well, guess what? The people who like Rocket aren't talking to you. So be careful. You're coming to the wrong conclusion from what you're hearing.
Fair enough. Rob, any parting words of wisdom?
Going back to what we said earlier, it's a call the market $2 trillion. Somebody's got to do those loans, and they aren't all going to be done by Rocket. So go out and get your share. Yeah,
Rocket's 5%. So there's still plenty. It just I think you need to level up your game. And I think, Sue, your metaphor was absolutely perfect. Rocket ran ads in the NFL, and it drove the industry to change the behavior around the digital point of sale. And I think this is going to drive the industry to change the behavior around the top of funnel and the full ecosystem experience. I think that was well done. What do you get?
Yeah. Oh, well, geez, let's close on that
Kudos.
then.
Yeah,
I mean,
That's an atta girl.
Thanks to everybody listening to the advisory angle powered by the Chrisman Commentary. And Rob, thank you. Garth and I are usually here in this corner once a month, but it was a treat to have you on. And so thank you for sharing your insights. And Garth,
my milk and cookies are waiting.
Oh my gosh. Well, we will let you go get right straight to that. And we will be posting the replay online as well as through the Chrisman Commentary. We'll make sure to get some of these links and articles that we talked to. We'll get them posted throughout. And thanks everybody for joining. And we'll see you next month. Take care, everybody.
Thank you.
Sounds good. Thanks, guys.